Hello and welcome guys. So in this video I'm going to show you this spike boom and crash index strategy that I've been using to milk the market for a long period of time. So this is a strategy that we're going to be using on 1 minute time frame, and you can use this strategy on boom 300 index, on crash 300 index, on boom 500, crash 500, boom 1000 and crash 1000 index, meaning we can use this strategy on all boom and crash pairs. So how are we going to be trading using this strategy? Number one, we have to first look at the market direction. So since we're going to be trading on 1 minute time frame, we want to use the 5 minute time frame and the 15 minute time frame to check the market direction. Taking for example, if I'm to go on the 15 minute time frame right now, right? So coming to the 15 minute time frame, guys, without doing anything or putting an indicator on our charts right now, you can see that this is a market that is continuously going upwards. And if I take my trend line to here and I draw it from down here and put it like this, you can see this is a market that has been continuously respecting this trend line, which means it is a market that is bullish, right? The other way that you can confirm that is when you do your market structure analysis. This is whereby you identify the market direction in terms of the market structure. So take for example, if we were to do a market structure analysis on 15 minute time frame for boom 300 index, we can see that this was a market that was printing high highs here at this point here, and it came here down here. It came down here and created a high low at this point, and it made a high here, and it also came down here again. It came here again and created this high low pattern, high low structure point as well, and it went up right there, break this previous high and created this new structure high point. And the market continued to do this, guys. You can see if I continue to do this, you can see this was the characteristics of price action the market was printing in this kind of market that we're looking at right now. And if I'm to continue, you can see the market was continuously repeating this. So this is what shows that this market is in an uptrend. When you see the market continuously breaking the previous high highs and making new high highs, as we can see here, this was a previous high, but it was broken when the market made this high. And the same happens for this point here. This was a high at some point, but the price came to this point and then pushed up and breaking this high. This is how you identify a market that is bullish, right? So since we are trading spikes, and if we are trading boom assets, we can understand that we are only looking for buys on boom assets and we are looking for sells on crash assets, because we are trading spikes alone. Since we have boom 300 asset here, we do not want to sell the market, but we want to buy the market. So which means that we do not want to get involved in a bearish market. What is a bearish market? A bearish market is a market which is consistently pushing down and breaking the previous lower low and doing something like this. This is a market that is going downwards. So for boom assets, we're not getting involved in a market like this. This is why the reason why we should do our market structure analysis. So simply what I'm trying to say is that stay away from trading spikes on boom assets. If the market is bearish, look for a market which is doing something like this. This is the market that you should trade, and stay away from this kind of market. Stay away from this kind of market and only trade on this kind of market. Why? Because you're going to see the market making big spike moves like these ones here. From here, you can see the market was just spiking upward. So if we are going on 1 minute time frame and trying to trade spike in a market which is doing something like this, we are more likely to be successful and we can milk the market. We can make a lot of money in this kind of market trading spikes, because the momentum is in support of this kind of market, so we can never go wrong. But if you trade spikes in a market which is bearish like this, which is pushing down, which means the momentum right now is in support of the small candles market. So if you try to trade spike here, you're going to see that you're going to make a lot of losses. You're not going to get those spikes that you want. Double, triple spikes. You cannot find it in this kind of market. So a simple rule that you can put for yourself is that you're not going to be trading spike in a bearish market if it is boom 300 or boom 500 or a boom 1000. For crash is the same. Since you are going to be trading spikes on crash, which means that you should stay away from a bullish market and only trade spikes on crash if it is a bearish market. So this is a simple concept, guys, that I wanted you to master. And if you can master that, I'm telling you, you can never go wrong. After you've done your market structure, you can see that this is a bullish market. So this is the kind of market that we're interested in trading. So if we now go on the 1 minute time frame, let's just go on 1 minute time frame. Right. We have confirmed that this market, right? We have confirmed, right? These are still our market structure on the lower time frame. We have confirmed that this kind of market, right, is printing what we call, right? Let me just put this, is printing higher highs, higher lows, which means that we are in a bullish market. So what I want you to do after you find your market structure, you are going to identify what we call the bullish continuation patterns or the bearish continuation patterns. So on boom assets, you're going to look for bullish continuation patterns, the likes of what? A descending channel, an ascending channel. These are all continuation patterns. We have confirmed that the market is going upwards. Now we're just waiting patiently for the market on 1 minute time frame to print these continuation patterns, and then we buy the market. How are we going to buy the market? This is what I'm going to show you. So since we have identified the market direction, I'm waiting for the market to print what we call a bullish or a bearish continuation pattern. And most of the time it is going to be what we call an ascending channel. This is an example of the patterns that I'm talking about. So some of the other guys may prefer to call them a bullish flag or a bearish flag, right? So what do you do now? You've identified this pattern. So what you need to wait for now is to wait patiently for the market to break above this channel. As simple as this. You've drawn your channel and you are waiting patiently. You wait for this first spike that will break this channel, like this one here. From that point, that's the point that you're entering the market. So you take your buying tool and you put it right here, and your stop loss somewhere down here, right? And then you take your buy entry right here, and you're targeting the highs, right? So imagine, guys, catching this whole move from here. How many spikes here? 1, 2, 3, 4, 5, 6, 7, 8. And we're talking about boom 300 index here. And there was no drawdown here. And you're just entering this market and you're catching about 10, 8, 15 spikes. Tell me, how much can you make? Even if you're having a small account, you can still grow that account. So let me show you another example very quickly. Right. So we are still continuing to do your market structure. You're understanding where the market is going. You're not assuming that the market will sell or it will buy. You know, if you just identify these patterns, the market is supposed to go in the direction that we have assumed when we did our market structure analysis. Right. So I'm going to draw this one as well. This descending. This was a descending channel here. It was descending, right? This was a descending channel. So you have to know these patterns, right? And it was making something like this. And the first spike that break out, it was this one. This is where my entry is. So I'm taking my buy entry from where? From here. This is where I'm putting my stop loss somewhere down here, and I'm targeting the highs, just like that. And I catch this whole move, guys. I catch this whole move. Just imagine, guys. So you're going to continuously do that, guys, and you're going to be making a lot of money in the market. So I don't want you to be greedy. If you can catch 3 trades like this per day, I'm telling you, you have done your market structure analysis. You understand where the momentum of the market is going. You've understood where the market direction is going. And if you do this, I'm telling you, you can never go wrong. Right? If you can catch 3 these good trades, I'm telling you, you'll be okay for the day, right? So look at this. This was another trade. Imagine, guys, how you can catch this. How you can catch this kind of moves. Easy stuff. This was a descending channel again. This first spike that break out of the channel, it was this one, and you take your buy trade, your stop loss still down here, and then you're targeting what? You're targeting the highs. You're continuously holding the market, taking some partials, and holding your trade. So this was another trade that you could have caught. Imagine, guys, catching these spikes. I don't know how many spikes right here. And imagine, even if you're having a small account, a $30, $50, $100 account, you can still grow your account to something else that is big, right? See how this move is big. So let me just show you. Let me just repeat the rules for you, guys. So basically, I'm just going to take this, right? Okay, so that you can see this. This is very, very important now. Right, so these are some rules that I have wrote down. 3 important rules of this strategy. Rule number 1, you have to confirm the market direction. What do I mean by confirming the market direction? Let me just do this illustration. I think it's very, very important. Our first rule is that we have to confirm the market direction. What are we confirming here? We are confirming in these assets. Is these assets moving according to the direction that we have to sell? This is what we are just looking for, guys. So which means if I'm checking my market direction for the crash assets, I want to see a market that is pushing down like this. What it means, what you do not see is that this market, the momentum is in support of the bearish market. This is what it means. So when you are looking to trade crash assets in a particular day, you should trade these assets in a market that is moving down like this. This is the kind of market that you should look for, right? For the boom assets, you are looking for a market that is bullish. So a market that is bullish, it is a market that is moving like this. Simple stuff, guys. Simple stuff. If you can master this, I'm telling you, trading boom and crash will be easier. Trading spikes will be easier for you. This is the kind of market that you're looking for, right? This is what I'm talking about when I'm saying confirm the market direction. So this is simply what you have to do. If you are looking at analyzing crash assets, you want to see if it is moving in this kind of market. You can check with the 15-minute time frame, with 1 hour and 5-minute time frame. If the market direction is in support of the bearish market, because we want to sell. Simple rules. We want to sell on crash assets. We want to buy on boom assets. If you are buying on boom assets, we are looking for this kind of market on 15-minute time frame or 1 hour time frame, depending on the time frame that you're going to be using for your entries. So, coming back to our rule number 2, wait for the price to create a continuation pattern. What are the continuation patterns? These are the continuation patterns that we're talking about, guys. These continuation patterns. This was an ascending. This was a descending channel. This was another descending channel. This is what we are looking for. So if the market creates a continuation pattern, our job now is just to wait for the market, to wait for the price, to wait for one spike that will break this channel, like this point here. When it breaks above this channel, then we enter, which is rule number 3. Enter when the price breaks above or below the continuation pattern. So you're going to enter here, you stop loss down, and you catch all these spikes easily, guys, just like that. So this strategy, you can use it on 5-minute time frame, 1-minute time frame, 15-minute time frame, 1 hour time frame, depending on your understanding or on your equity. So if you have a small account, when I'm talking about small accounts, I'm talking about an account that is 200 and lesser. You should use the 1-minute time frame and 5-minute time frame only, right? So if you have an account that is lesser than 200, you're going to be using the 1-minute time frame and 5-minute time frame. And the other thing as well, do not leverage all of your account. Leave some margin for the market to move. Respect your stop loss. If you say your stop loss is going to be down here, leave it like that. Leave it like that. You see, you're going to get to another level when it comes to catching spikes easily without any indicator, the smartest way, the sharpest way, and the snipest way that you can ever do. So guys, I hope you enjoyed this strategy.